Hey everybody, Signet here with the Bullish Bears. So in this video we're going to talk about trading the gap. This trade is done on the futures. You don't want to use this tactic or strategy on equities, but you can use it on the ETFs, SPY, QQQ, IWM, and DIA. So for those of you who don't yet have a futures account, you can do this with options on those indexes. So let's go ahead and get into it. The gap that we're going to trade is the gap that is created during the Globex session. So while you see candles here, and it looks like the market was moving all night long, in reality the market had closed at 4:15 and it opened back up at 9:30 in the morning. In those overnight hours, if the market had moved to the upside, then at the bell we expect to see a market try to close that gap. Notice I did say try to close that gap. So it doesn't always do it, and the opportunity to trade this can get you day done very early in the trading day. One thing that we want to recognize is that a bullish market will more than likely fade at the open to try to close that gap before continuing on with its bullish move. And even on a day like today, while we didn't actually continue running bullish to the upside, we did maintain the range, right? So it opened at right around 34.15, dropped down to close the gap, ran right back up, and now it's just holding that range. So not necessarily bullish, but it didn't turn bearish, right? This is like a bullish neutral. The opportunity, though, was to either trade this down or trade it back up. And that becomes one really nice trade in the morning. There's multiple ways to trade the open. One of the ways that I find very effective is to see inside of these candles. This gets us to a fractal logic. So fractal is something that you see in nature and science and photography. The idea is that when you zoom in on something, you see the same thing, and then you zoom in again and you see the same thing, and that's fractal in nature. The analogy often given is, think about a tree that you see in a distance. You got a trunk and branches. If you walk up to that tree and you was to grab a branch and you look at that branch closely, it is a trunk, and from that you have branches. And you could do that all the way down to the leaf, and then if you look at a leaf, it has a center trunk and then it has branches. The same thing applies when we're talking about candles on a candle chart. If we go out to a daily, this one single candle has an open, high, low, close. But I know there's price action I could trade inside of this. I just need to get into a smaller view. I need to see inside of this candle. Fractal says if I zoom in to this, if I look in it from a smaller perspective, I will find more of the same thing. So here we are on a 60-minute, and if I zoom into these, each candle is 60 minutes. It's a 1-hour candle. I can see the open, high, low, close, and I know that there is trade activity inside of that 1-hour candle. I just can't see it. I can't see what's going on in there. I need to get into a smaller time frame. We can continue to do that all the way down to a 5-minute. Now once we're at a 5-minute, we can't go any lower in time. At least I don't like to. I don't like a 2-minute chart or a 1-minute chart. I don't find them very valuable or trustworthy. The patterns fail a lot. It's a lot of wick and a lot of chop, and I just don't see an opportunity. But I need to see inside of this 5-minute candle. So at this point, what I would want to do is move over to a tick chart. But I find tick charts to leave me blind, and I can't see what I'm used to, which is time. The way that we resolve this issue is we use what I call an anchor signal chart. Okay, so pause the screen here, and I'm going to get out my anchor signal chart. Okay, so here we are on the anchor signal chart. You can see I still have the 5-minute chart on the left, but I've added a chart on the right side, and this is a tick chart. It's 500 on the MES. I paused, or I rolled the chart to where we could only see one 5-minute candle. And I want you to take a good look at this 5-minute candle. It's a very wide candle. It's almost 14 points wide. Almost. It's a pretty good sized candle. We know that there is activity inside of that 5-minute candle that we could trade, but we can't see it. If we bring up a tick chart, now we can see it. And when we're trading trend, these pullback opportunities are where we look to get into a trade. So now when I'm on a tick chart, I can see the market breaking through structure, right? It breaks down through this. We get a Busby pullback, an opportunity to get in, makes its move. We can get risk out here. And then in the next drawback, we can add back to our position, look to hold the original contract from here, get risk out right around in here. We're still short with one at least, if not multiples. In the drawback, we can add to our position, catch another opportunity, and take it down into its next move, looking for the next pullback, right? We could look to get risk out somewhere around in this range. And then in this drawback here, we failed to maintain a position. So if we'd have tried to add into this, then we would have ended up just getting stopped out on both, right? It did not continue to make its move. Now, how would we know not to get back in again after getting stopped out around this range? We would maybe be able to recognize that because this was a bullish day that opened bearish just because it was closing the gap. Now, I like to trade the gap more often than not back up after it's made its move down, or back down after it's made its move up, right? I'm busy. I can't always watch the immediate open. Sometimes I'm not sure if it's actually going to close a gap or not, so I will wait and let it close the gap, and then I will jump on and ride it back to where it came from. So if you didn't have the comfort level or the skill level to trade this to the downside, you could wait for it to validate the lows, to make it down to that gap close, and then trade it back up in the other direction. All right, I added some lines to the chart, and the lines that we see here, we have the kind of a pink line. That's moments before the open. We have this red line, or a light pink, and that was the low of the previous day. And then we have this orange or yellow line down here, and that was where the market opened last night. Now, we didn't quite make it down to that level, but we did run across yesterday's lows, and that's where we got hung up. So that would have already been a warning right there when we hit this level, that we might not have wanted to take out the next pullback opportunity, because at this point it could have given us a V-shaped reversal and just completely overwhelmed our position, right? So we had the pullback opportunity here. We had the entry from this pullback opportunity here. We could have got risk out along the way, and we would have wanted to avoid one more pullback looking to get to this low. If we hadn't already made our opportunity and been day done, we would look for a reversal at this point. Even if the market does come down and finish this slight move, your risk reward is still better set aiming to go back up at that point rather than to take that tiny little bit left. And as you can see, it tried again and failed again, right? So here it started to form a strong basing pattern, and then it reversed and made the move back up. This is reciprocation. Okay, so if you didn't make the move down, you easily could have made the move back up with an opportunity to get in at these drawback points, right? At 786 drawback, or if you're using moving averages, maybe you could use those to get in. I'm not a big fan of moving averages for trade entries, but to each their own, right? So let's see what this looks like on the 5-minute as I roll across. There's that red line. It made its move strong and aggressive to the downside, stabilized there at the previous day's lows, and then it rallied right back up again, reciprocating back up to those highs. So this is the pattern, guys. This is exactly how it works. To get more familiar with this, or to be able to trade this, you're going to need to grow some respect for it, some trust in it. The only way to do that is to go back and look at every single open and spend a lot of time and a lot of effort trying to analyze the open of the market. I never do things in a single perspective. So for me, when I'm trading this open, I'm watching market watch. I want to see what's going on with the money flow. I want to get confirmation that we're actually moving in a certain direction just to close the gap, and that we're not actually falling. All right, because we had in the example that we were looking at last night, it was slightly bullish, right? It did make its way up. It wasn't an aggressive move to the upside, but it did work its way up there. At the open, this could have just turned completely bearish and crashed and burned. We wouldn't have tried to take that reversal if that was the case, right? And the one way that we can identify is by using this, by looking for divergence in the money flow and in the issues. So that's one tool that you can use when you're trying to trade the open, is looking for confirmation in the money flow and in the issues. So you got capital and issues, and that's what you want to watch. So that's one way to do things. The other thing is you don't want to do anything blind, right? So if you're trying to trade the ES, watch the NASDAQ, watch the Dow, the Russell. You can kind of keep your eye on the tick, but at the open, I have found tick to be unreliable. You can also look at the ADS-PD only from the perspective that if we're very extreme, then we're going to want to see a market immediately drop in the other direction. So here we opened at 400. That's very positive. It's extreme. We would expect to see a market fade at the open because of this. If it had opened extreme in the other direction, if it was way down here opening at minus 400, we would have expected to see a market pop up at the open, right? So there are many tools that we can use to help validate our belief that a market's actually going to close the gap. We don't want to just assume and pull the trigger and hope that it does. There's many confirmation tools that we can use along the way. And if you find yourself unsuccessful at taking it to the gap, look to trade the reversal. Wait for it to actually get down there, build a basing pattern, and then go the opposite direction and ride it back up again. You have both of those opportunities, and when you get really good, you could actually trade both sides, ride it down, and then flip over and take it back up the other direction. This is a fully formed system. It's a complete trade, and you can be 100% day done with 30 minutes into the day, right? Maybe 45 minutes, you're completely done. You've hit your goal, and you can walk away and go do something else. These pullbacks are really great entries at the open, and you can see them really well when you're using an anchor signal chart. Now, a tick chart, which is what we have on the right side, it kind of becomes a little arbitrary on what the appropriate number is. I get asked all the time, what number should I use? There's not a set number. If it's the micro that you're trading and it's the NQ right now actually has higher liquidity in the micro than it does in the actual NASDAQ mini. If it's the ES, it's the other way around. The micro ES isn't as liquid as the ES. Still tradable, absolutely still tradable, it's just not as liquid. A tick chart is volume, it's order flow. So when there's not as much liquidity, you can't use a higher number. Otherwise, you're going to end up with a chart that looks like this 5 minute, right? So you have to try a couple of different numbers out and find one that fits you. You need to be able to see inside of a 5 minute candle. That can be the basis for what number you try to use. And when you do pick a number, stick to it. Use it for 6 to 8 weeks. Be very fair about your evaluation of it. And at the end of that 6 or 8 weeks, make a decision. Do you need to go up in your numbers, or do you need to go down in your numbers? It really is a very arbitrary number. Nobody can give you the number as well as you could pick your own. Okay, so if you want to use the 500 on the MES because you've seen it here in the video, that's fine. That's a good place to start. But I would like to think that somewhere along the way you'll decide on your own to move this up or to move it down. This is also a number that we were using at the open, and there's a lot more liquidity at the open than in the pre-market or at lunchtime. So that might be a number that needs to be adjusted at that point too. You see, so it may be a good starting spot to use the 500 on the MES at the open, but you would certainly want to find a better number at that somewhere along the way. So to review this, when a market gaps up in the overnight hours, we expect it to fade at the open down to where it had closed the night before. If a market gapped down in the overnight hours, we would expect it to pop at the open back to where it closed in the previous hours. Okay, it really is that simple and that basic. If we go back and look here, the market closed around 30.71. It opened at 30.58, so it had gapped down in the overnight hours, and you can see that it didn't even try, it didn't even attempt to make a run to the upside at this point. It just immediately fell, and at that point we'd say, look, there's not going to be a gap close today. I do use the words gap resolution. So the resolution is the question, right? Are we going to trade and close that gap? We're trying to resolve that question. And so gap resolution, if you've heard me talk about that in the streams, it just means that we've resolved the question. And the question, of course, is, are we going to close that gap? Are we going to close the gap first before we do anything else? And what I mean by anything else is if we start to form an open range, we're not going to close that gap, right? We're not going to close that gap first. At that point, it won't be done first. It might be done at some point, but it won't be first. So if you can identify a 5-minute open range and we're still inside of that range 5 minutes after that, we're more than likely not going to close the gap first. We now have an open range, right? It's just as simple and as easy as that. Trading the gap does not have to be hard, and it does not have to be difficult. What I've noticed that people do when they say, hey, Sig, I really lose a lot trying to trade this. Can you give me some pointers on the open range? And when I ask them, are you waiting or are you guessing that it's going to close the gap immediately at the bell and jump in? They mostly tell me, well, it gapped up in the overnight, so I just jumped in at the bell expecting it to close the gap, and it didn't, and I got ran over. Or they're using too tight of a stop. So if you're going to trade the gap, you don't want to guess that we're going to go down there and close the gap. You don't want to assume that we're going to go down there and close the gap. You want to wait to see an entry to get in and trade with structure and logic behind you. If we go back to today's range, here's that 5-minute candle again. All right. So the market opened and it immediately moved to the downside. That's a good start because we were looking to get down to this yellow line. It drew back and it got hung up at this near-term pivot point right there. So there's our drawback and our entry to get in. But look at those wicks. Okay, those wicks are pretty long. If you're trying to use a very tight stop at the open with a resting order, you're going to get stopped out a lot. Now, you could get right back in again, but those getting stopped out just adds to those losses, right? And they keep adding up. So you need to make the decision on how you're going to enter into this trade. Do you get all in at once? Say you're willing to take 3 shares or 3 contracts. So if 3 is your all in, you don't have to get in with all 3 at once. You could choose to start with 1. Say it draws back and it hits the spot that you want to get in, and you say, well, I'm willing to risk, this is the MES, so we'll say I'm willing to risk $25. That's 5 points. So we have a stop above the open up here at 315 with 1 contract. We get entered. It starts to make its move to the downside. This deep thrusting red candle right here might be all the confirmation you need that this drawback was a good entry, and you could pull the trigger on a second entry. So now you're short 2. Okay, your all in is 3. You're short 2. It makes its move. Everything's going great. You get another drawback, and you could look to enter into your 3rd one here, right? So this whole time, we might have been able to tighten up the stops, adjust what our overall risk is, and still kept it underneath $25 of risk the whole way. Entries and exits are a big part of trading futures. The gap play is no different. You need to be in full control of your risk and realize that you don't have to get all in and all out. You can fade in and you can fade out and you can fade back in again. So you just need to have a very definitive reason for getting in. Are you trading a pullback? Does that pullback need to be based on Fibonacci, or is it defined on structure? Do you know where we're going? What confirmation do you need that the trade is still in play? Okay, I'm not one who's very interested in trading breakouts. So in a move like this, I would not have wanted to see a breakout and jump in here. I would not have wanted to see a breakout and jump in here. That's me. I don't trade that way. If you do, you need to define what your rules are going to be for getting into that kind of a trade, right? So this is the gap play, guys. It is not difficult to do. You just have to wait for your opportunity to get in. Realize that the open is very volatile, and because of that, we might not be able to use as tight of a stop as you're normally used to. So look at the money value that you're willing to risk. In this example, I used $25. If I was doing all 3 contracts at once, that would be $15 per point. I'd only be able to go maybe a point and a tick. But if I used one contract, I could put my stop 5 points away and give me room to run, to enter the trade, let it validate, and add to my position. All right, guys, that's what I got. I appreciate your time, and I look forward to seeing you at the next video.